takeaways, give you some real insights into what I think is happening in the Sydney property market. We'll keep it quite Sydney-centric. And there's already quite a lot of noise that's in the market. And what I want to do with my background and experience and every day dealing with property developers and the like, you can see my background there. I used to be the CFO, COO of HSBC Bank. And during my time in banking, which spanned over 34 years, I had a lot to do with the RBA. I had a lot to do with APRA. I was the key contact for APRA in the 3 or 4 banks that I've worked in my career. And have been a lot of industry committees as well. So I can hopefully give you some real insight rather than what I call scaremongering from what you see normally in the media. Media picks up a news and it is very difficult for individuals to decipher what is the truth in the market. And hopefully that is what I would like to, if I can give you 3 good takeaways today, then I've done my job. Okay, without taking too much time, this is history. Everybody knows what happened in the property market in the last 12 months, okay? 12 months, 15 months, 18 months. Property market has been very, very strong. And Sydney, you know, this is up to 31 January, but it hasn't changed much in the last 3 months. As most of you know, the market is stabilizing at the moment. So Sydney has had a growth of 25.5 in that period to 31 January. Brisbane's been a stellar performer, 29.2. Adelaide's been strong, Canberra's been strong, and the regional areas have been strong as well. Pretty much every market has been quite strong, okay? So what I want you to firstly understand is that this type of growth, a 25% growth, is not something that happens every 5, 10, 15 years. Absolutely not, okay? So this type of growth has only happened twice, 2 other times in the past 100 years. In 1989, we had 29%, and in 1950, we had 111%. So there are a number of factors, and I'm not going to go through all of them, that cause this type of growth to happen. And we will talk a little bit more about that in a second. But what I want all of you to know is this is, and some of you may have come from different markets around the world and seen other markets in the world. It is different in Australia. We have not seen this type of growth. Only 3 times we have seen this type of growth in 100 years, okay? And I will also say that when you're looking at these type of numbers that are published, 25.5, it is the median of all types of properties across all of Australia. So across all of that city or Australia, right? So when we are looking at properties, I will say at the outset that different suburbs actually perform differently. Sydney is not a one suburb, one property market. Sydney has probably 20 property markets in the same city. And then different classes of assets like apartments, houses, and so on, townhouses, duplexes, different types of properties behave differently in terms of its growth. And this actually shows you that very, very clearly. So in that same period that we just talked about, we're looking at houses in that orange, and the blue is apartments. So Sydney, yes, houses actually on a median price basis, if you look at all the houses that were sold in Sydney during that period, it actually averages out as a median at around 32%. If you look at the apartments right across Sydney again, you will see that it has been below 15%, somewhere around that 12, 13%, okay? So this gap here is enormous. In some suburbs, you have seen house price growth actually up to here, somewhere around that 50% or even 60%, okay? There has been that type of growth in some suburbs in Sydney during that period. And in those same suburbs, and I can name some of them for you in a minute, the apartment prices might, in some suburbs, have only gone up 5 or 6 or 7 or 8 or less than 10%. So my point here is that this gap is there, and I'll talk more about this gap today. And we in any property market, there are always opportunities. And tonight, I'm going to talk a little bit more about that opportunity that we have presented to us. So in the news, what have you been seeing in the last few weeks in the news? Some of the key things that sort of makes the needle move when it comes to property prices. First and foremost, you can see that our jobless rate is the lowest since records began in New South Wales, okay? It's 3.7% now. Our unemployment is 3.7%. I have lived here for 40 years, have not seen anything near 3.7%. Okay, nationally, we're at 4%. That is also extremely, extremely low. We are heading lower, okay? This is almost full employment and we are heading lower. So this factor is a very important factor and it's been in the news a lot. Albanese could not tell you what it was, but we won't go there. Australia faces national rental crisis as vacancy rates fall. So this is one of many, many articles you have seen in the last 2-3 weeks. This is big news at the moment, and we'll talk more about that. Rentals are a very important factor when you're looking at property prices. And one of the key reasons why property prices for apartments did not go up as much as houses was because there was no rentals and investors did not invest. Migration did not happen. Students were not coming here. COVID caused that phenomenon. Wage growth is getting healthier. So increases to 2.3%, which is healthy. It has been flat for quite a while, mostly through COVID. This one's very important. The border is opened. And we've seen quite a lot in the budget about the support for skilled migration to get a stronger Australia. So these are the headlines. That's what's making news at the moment, particularly as it relates to properties. Now, last year, March was the biggest 1 month growth for Sydney in terms of property prices. 3.7% is a big, big, big move in 1 month, okay? Then it's been mixed bag over here, 3%, 2%, all the way to December. I haven't updated this graph up to March because the last 3 months, as I said, not much to talk about. We've had a jump in January, and in the last month, we've actually had a negative number, a small negative number, 0.1% minus. But net in the last quarter, we've had a slight increase again. So this trend, once this trend happened, everybody, all the media started talking about the fact that the boom is over and the market is flattening. So let's talk more about that in a minute. The next one here is a very important, my top 7 things that impact the price movement in property. So this is in some sort of order. Economics 101, if any of you have done that in school or uni, supply versus demand is the key factor, the #1 factor with everything, okay? It does not matter whether it is properties or cars or any commodity. If supply is high and demand is low, prices are gonna suffer. If supply is low and demand is high, you all know that, okay? It's common sense that when everybody is looking for the same thing and there is less of it, you are gonna pay more. And we saw that with land prices last 12 months, 18 months. We've seen that with land prices in Sydney. And the supply was getting lower and lower and the demand higher and higher. And that is still the phenomenon with land in Sydney, okay? So we will talk more about supply and demand. And one of the key factors why prices went up 25% in Sydney overall is because of this factor here, supply and demand. The second point there is also very important, and that is why it is my second point. Interest rates and affordability is absolutely key. Now, interest rates, again, very highly publicized, is going up. Is it going to go up? Absolutely, it's going to go up. So I've been holding these webinars now for a long period of time, since August last year, and I have recordings for all my webinars. Since August last year till now, I am still of the belief that we are going to see 2 interest rate increases starting from about July this year, and then probably another 2 potentially up to June next year. So in the next 12 months, it's highly likely that our interest rates is going to go up by about 100 basis points, which is 1%. Why is interest rates going up? And I put affordability here as well. And why I've put affordability here is because affordability actually caused this demand to go through the roof. It's because there was interest rates, we never thought, because of COVID, the interest rates had to go, the cash rate went to 0.1%. You could get interest rates at around 2% per annum for owner-occupied properties, even sub 2%. I know people who've got loans at 1.89% and they've locked it away for 3 or 4 years. So affordability went through the roof because we had falling interest rates over a sustained period. And where people could borrow 500,000, they suddenly could borrow 750. Where people could borrow 750, they could suddenly borrow 1.1 million, 1.2 million. So that was a big factor. Inflation is what is causing interest rates to potentially go up. Inflation does not behave the same way in every country. And inflation has gone up even more. And you've seen a lot of cost of living discussions going on at the moment, because of petrol prices going up, because we have a war going on at the moment. Those factors are causing it. But for local, if we bring it to local, what is causing inflation to go up? So inflation is now heading north of 3%. And the Reserve Bank wants inflation to be somewhere between 2 and 3. For them, between 2 and 3 is healthy. Once it goes above 3 to 4 and to 5, which it will, and I'll tell you why it will because one of the big factors is food prices, petrol prices, rentals, okay, cost of our normal day-to-day purchases that we do. Those things make up the CPI, or what we call inflation. And as those things go up, that causes pressure on inflation, and then causes pressure on interest rates. Wages growth is something we need to watch very, very closely, because these two factors both have to go up before interest rates are going to. Inflation alone will not do it. If there is no wages growth, the RBA may hold off for longer. RBA has been very clear in actually saying that we will actually move interest rates, but we'll move it slowly and explore what is happening, see what the impact is. It's not going to be anywhere near what New Zealand is doing. They just went 0.5% up. It's not going to be anywhere near what the US is going to do, what the UK is going to do. Okay, the inflation rates in US has gone through the roof, 7% plus. UK is now heading around 6 to 7%. So those markets are going to move. But we don't have to follow those markets. We will take it slow, okay? Now, will interest rates going up by 1% have a material impact on the affordability and our house prices? My answer to that is absolutely not. Absolutely not, okay? You saw my number there of 29% in 1989. So 29% increase was the last time we had a major boom in the property prices. Interest rates at that time, you might note, was 10%. 10% was the borrowing rate at that time, okay? It does not have a direct correlation with property prices, not a direct correlation. But the figure that is even more important for me than interest rates is the actual inflation. When inflation goes up, price of everything goes up, including property prices. And I will come back to that in a minute, because the cost of construction goes up, property values go up. The next one here, and we're going to keep an eye on wages growth. We're going to keep an eye on inflation, because those two factors are going to cause this to happen. Okay. APRA is very important. APRA is the regulator for banks. Banks obviously lend money. They are your mortgage provider. Okay, half of a bank's balance sheet in Australia is mortgages. So if you look at any banks, the big four banks' balance sheet, if someone's got $800 billion on their balance sheet, then 400 billion of that is actually mortgages. Mortgages is the residential mortgages, by the way, not commercial mortgages or any other mortgages. Residential mortgages make up 50% of a bank's balance sheet. It is their bread and butter. It is the biggest asset class. Nowhere in the world, in any bank, would you find that your asset class of mortgages is 50% of your balance sheet. Only in Australia. Why? Because we have a huge appetite for people to borrow and invest in properties. And that is why. And banks have always been happy to lend money in the residential mortgage space, because in that space is where they make most of their money. Okay, the margins are not huge. Okay, the margins are down to around average 2% for residential mortgages. But when you look at a big book like a $400 billion book, then it is a lot of money for banks to make. It's their bread and butter. APRA regulation is very important. APRA regulates banks. APRA will very closely watch what is happening in the property market. And more than RBA, the Reserve Bank, APRA has got a number of levers they can pull to impact how the bank's lending criteria works, how they work out, what impact it has on their policies and their delinquencies. There are a number of things that they can actually look at to put policies on banks. Okay, very, very important for us to know. So there used to be, for example, a lot of low doc loans. They use the percentage of how much investment loans you have versus housing loans. All of those type of things, APRA can come in and dictate policy to banks, and that in turn then actually has a knock-on impact on how the bank actually prices their mortgage products, and then it impacts the customers. Okay, so that's number 3. That is always very important, and they have recently changed your ability to repay calculation that the bank does, your affordability. They have raised the buffer has gone up by from 2.5% to 3%. What that means is when you're borrowing at a variable rate of 3%, the bank assesses you whether you can actually pay at a 3% buffer, which is 6%. So they will assess you at 6%. Okay, there's a lot of media at the moment that, and you'll see more of this when interest rates go up. Okay, you will see this after elections are done, and you can see a lot of media. As soon as a 0.25% interest rate increase happens, all this negative news is going to start coming out. Or we're going to see mortgage in possession sales. You see this 6-point bank delinquencies and loan write-offs. Well, we don't have a lot of loan write-offs. Banks don't lose money on mortgages. Okay, banks do not lose money on mortgages. So when a bank lends you at a loan-to-value ratio of 80%, which means you come up with 20%, they give you 80%. Guess what? If that loan was done 3 years ago, now the bank is sitting on 50% loan-to-value ratio. But the bank cannot lose money. Okay, neither does the person actually who is having difficulties paying the loan. Neither do they actually lose money, because when they sell a property like that, both parties will walk away with money, the owner of the house and the bank. Okay, they're not going to lose money. So in all of my time sitting in risk committees in banks, okay, whether it is working at St. George, Westpac, HSBC, I can tell you that delinquencies and loan write-offs in residential mortgages is nothing to talk about. It is, in a 4-hour risk committee meeting, you will talk about it for 5 minutes, because banks do not lose money in this space. Even the floods you have seen at the moment, they're not going to lose money. Even the write-offs they're going to have is not even 0.1% of their mortgage book. Okay, so it's nothing to worry about. Fourth factor, I will spend a couple of minutes talking about. Everyone came out in 2020 and told you that unemployment is going to go through the roof to 12%. We're now down to below 4%. And GDP is going to suffer, so that we're going to have a recession. We're going to have negative growth for a long period of time, and that's going to cause sustained amount of recession. Okay, so that was the worst scenario. All the economists came out, and mostly the big 4 banks economists came out and said the property prices are going to fall anywhere between 20 and 25%. This was middle of 2020. You all were here. You all know about that. And in that 12-month period after that, we all know, and we know what has happened. Instead, it's gone up 25%. So minus 20 to plus 25 is getting it wrong by 45%. These people have not been held accountable. These are the senior economists of all our banks and financial institutions in this country. I did not believe that in middle of 2020. So I went and wrote an article in the paper and said that it will actually go up 20% in the next 12 months. Okay. So for 2021, my prediction in July of 2020, my prediction was up 20%, when the rest of markets was looking at 20 to 25% down. I won't go through. I'm happy to share that article with anybody who's present today, but it's very simple. The people who are losing their jobs, who were on average salaries of 45, 50,000 in the hospitality industry, airline industry, and so on, were not people that are going to move the prices. So people working in offices did not lose their jobs. The other thing is GDP. We knew with all the incentives the government was doing. So that's the next point. The government spending, the infrastructure, JobKeeper, job seeker incentive, all of these incentives were making sure that the economy is still going to continue to grow and the unemployment will be in check. It's history, but it's good for you to know that it's knee-jerk for people to actually jump on these things and make those very, very bold predictions. And that's why it is important to decipher all of this noise from the market and understand what actually happens at the coalface. Now, this one, and that's continuing to happen with elections. There's going to be more and more of this happening. Okay, we will go below, in my view, we will probably go below 3.5% for unemployment, which will be like never seen before. And we will see continued spending by the government to make sure that GDP continues to grow. It's bounced back very, very strongly. Last point there is global factors. Global factors have some knock-on impact, but not massive, okay? The biggest global factor, actually, if I look at the last 20 years, the biggest global factor in terms of moving the property prices here was that there were a lot of apartments bought by, particularly from Southeast Asia, China included, and they bought a lot of the plan apartments at premiums and pushed the prices up. These other things like bond and equity markets and so on, they don't have a huge impact. That's why it's number 7. Okay, without further ado, one of the key slides for today, one of your key takeaways for today, okay, is, and these are all New South Wales Treasury numbers. This is Sydney, New South Wales Treasury numbers. But we're talking here about Sydney. By 2036, we're going to have 6 million people living in our city. And by 2054, we're going to have 8 million people living in this city. This is massive growth in population, okay? To cater for this type of population growth, we're going to have almost 40,000 new dwellings every year. Keep these numbers in your mind, 40,000 new dwellings every year. So last 2 years, the apartments suffered. No migration, no students coming here, investors not getting into the market. Third reason is that people who are actually buying house and land packages, and some of you may be listening today who may have done that or know somebody who's done that, were actually moving out of apartments. We sold a lot of house and land to people who are moving from their apartments because suddenly they could afford a house and land package. They were staying in Homebush, Parramatta, Westmead, Wentworthville, all of these suburbs. And they were looking for a house and land package in Northwest, West, Southwest. And that was one of the reasons. Apartments suffered. But this number is a big number, okay? And you will see that because of COVID and because migration stopped, the number of starts in new dwellings went down. We'll see that graph in a minute. The key here is that this amount of people coming into this city, which is going to be growing to 2036 all the way to 2054, requires significant infrastructure to cater for those type of people. So what you're seeing in this city right now is roadworks happening, airports starting to get built, Atropolis is going to start soon. That is a massive, massive project. It's another city like the size of Parramatta being built near the airport. Then you've got all the tunnels being built, hospitals are getting upgraded, new hospitals are getting built, schools are getting upgraded, universities are getting upgraded. Everything is happening in this city. This is what you call a twice in 100-year event. This type of paradigm shift, infrastructure, call it what you like. It is the gentrification of a city is something that you are seeing, you're witnessing once in a 50-year event, okay? And the reason for that is this New South Wales Treasury numbers is to cater for this population. You're going to see more rezoning, you're going to see more apartments, you're going to see more coming up close to metros and more coming up close to train stations. The density is going to increase. That is the only way, because we're running out of land. In the Northwest, we're going to run out of land in another 8 years. There'll be no more land to sell in the Northwest of Sydney. In the Southwest of Sydney, maybe that'll go for another 12 years. but you'll keep going past Camden and those areas, another 10, 15, 20 kilometers, okay? So land is running out. Only way we're going to cater for this population is higher density. So keep that on the back of your mind. And each year, sorry, I'll go back once. Each year, the migration in our city is about 95 to 100,000 people pre-COVID. 95 to 100,000 people is how we get to these number of dwellings, okay? Keep in mind that stopped for a couple of years. There's been a pause. So the people who are holding visas are going to come here. The new migrants are going to come here. So it is quite likely that in the next 2 years, instead of seeing 200,000 people, we potentially could see 300,000 people come here in the next 2 years. Keep that on the back of your mind because that is key. Okay, everybody's doing the forecasting again. So these are the big banks, ANZ, CBA, NAB, Westpac. Everybody's saying this year we will see, this is 2022. This year we'll see a bit of growth. Everybody's got growth this year. Yeah, that's blue. Next year, it's going to be down, okay? And mark my word, as soon as the interest rates go up once, they're going to revise all of this and give you a more pessimistic view of what's happening in the world. My advice to you, don't listen to them. They have been wrong by 45% in 2020, okay? They very rarely get it right. This is SQM. They're a good research company. They have run a number of scenarios here to give you what is going to happen in 2022, okay? So this was the last figure last year. And then they've got cash remains, if the cash rate remains the same, and you've got inflation growing, APRA action, then this is this, and so on and so forth. Their worst scenario is -7 to -2. Best scenario is 3 to 8. This is just for your information, what the market is telling you, okay? I like to make predictions, and I keep making predictions actually. So these are my predictions for this year, and I have broken it down into houses and apartments. The same way that you saw before the graph, it is gone flip-sided. Houses, I think, is going to go up 5% this year, but apartments, I am thinking is going, I'm forecasting is going 14% up this year. In 2023, houses will be pretty flat. Apartments will still be rising. So between now and end of next year, I am looking at 20% increase in apartment prices. And this could well, if you see the next few slides, you might be thinking this could well go to 25 to 30%. Houses, that is probably where it's going to be, okay? The biggest headwind, I've already told you, is interest rates. That is the biggest headwind. Offsetting that headwind is, number one, is demand. Demand is going to continue to be massive. We just opened our border, okay? But the other thing that I will talk about shortly is the, and you'll see it here. So the supply and demand is very well explained in this. Now, in the next 6 to 24 months, what I'm trying to say is this is a perfect storm for apartments, okay? But don't jump in and go and buy any apartment out there because I say so. This is the first thing. There's a perfect storm for apartments, but you need to know what to buy, where to buy, and the right price. But I'll go through these 8 points and why I say this. One, we're still at historically low interest rates, and there's a high appetite for banks to lend. That's number one. Appetite for banks to lend will continue in the residential mortgage space because that is their bread and butter. They're not going to lend as much money to small businesses. They're not going to lend into risky assets and personal loans and other things. And they're not going to lend into commercial property because commercial property, in my personal view, is not going to do very well. A lot of commercial property in the city, particularly in CBD areas like in Sydney CBD, will probably be converted into apartments because people are 50% or more of people are actually working from home. So banks know that there is risky assets out there, but they know that in residential mortgages are not that risky. So they're going to continue to lend there. Okay, let's not lose sight of the fact that I paid 17% for my first mortgage in Sydney, okay, in 1983. Rates have been high. I never thought I'd see 2%. even at 3%, even at 4%, interest rates are still historically low. Don't lose sight of the fact that we are in a very low interest rate environment. If anybody tells you that it's going to go to 7 or 8%, they don't know what they're talking about. Okay. There is one politician who is talking about delinquencies and people losing their homes and losing money because rates are going to go to 7 or 8%. It's not going to happen. Okay. So the other factor is the world is in a global, there's a lot of countries still in recession, still coming out of COVID, still trying to see above water. We are in a good place. Okay. So we don't have to follow the rest of the world in terms of our interest rates, and RBA is going to be very tight on that. Demand will continue to be strong. So demand, migration, you know about, expatriates and students. There are 550,000 expatriates working overseas, whether they're in the Middle East earning very low tax dollars, or in the UK, they're all over the place. Okay, Southeast Asia, of course, there's a lot of expatriates. There's 60% of expatriates who were interviewed during COVID, in the middle of COVID. 60% of the expatriates said they want to either come back home or they want to at least purchase a property back home. So this demand is going to come from there, already is coming from there. The top end of the market, you all know that it's already gone up quite a lot. So if you look at the prestige properties in Sydney, the prestige properties in Sydney actually went up more than any other city in the world, Western city in the world. Okay, so people are snapping up. There is a land, 900 square meter land in Manly. I don't know if any of you watching actually saw that, but it was about 3 or 4 weeks ago. A 900 square meter, not on waterfront, just water views, actually went for $20 million. Okay, not waterfront, not in Point Piper, in Manly. Okay, with water views, not on the beach. 20 million for the land, got an old house on it, 900 square meters. So this is already happening. So we've already experienced the high end. That sort of filters through the rest of the market. So that will be continued demand. Investors are finding. So we've got a showcasing a property, a project today, and where you'll find that it's not only positively geared, but it's cheaper to buy than rent. Okay, so this phenomenon is very much there. It hasn't happened. It has never happened in my 40 years here where something is cheaper to buy than rent, or where you find a lot of positively geared properties in Sydney as you do now. And now Foreign Investment Review Board approvals is also heading up. People who are not residents here, don't have any residency, they're applying for FIRB approvals to buy a property here. All these things are going to cause demand to continue to be strong next year, this year, the year after. This will continue. Now, this is probably one of the most important things you need to know. We all know about demand, but the supply is significantly down. Okay, I want to show you this graph on the right. This is one of, if there's only one thing you take away today, please understand this graph, because nobody is talking about it. In 2022, these are apartment completions. Okay, in Sydney, apartment completions, 2022, 14,000. 2023, 9,600. 2024, 4,500. This downfall is because during COVID, everybody stopped. The developers stopped. It takes 3 years to actually start and finish a project. It takes 1 year to get your DA approved through council. Then you've got to go develop it. Then you've got to complete it. We have got supply issues with supply chain issues with materials. The cost of construction is gone up. All these factors are happening. This is the biggest thing you all need to take away today. If people say to you, there's apartments everywhere, don't even listen to them, okay? I cannot say it any more strongly to anybody listening today. They will talk about this in 2023. They'll talk about it in 2024. Nobody's talking about it now, okay? So there's less and less land being released. There's fewer apartments being developed. And guess what? With the stronger demand, the smart demand graph is going up, the supply is coming down. What happens? That's my economics 101. Supply demand, inversely proportional here. That is going to push prices of apartments through the roof. I'm saying 20% by the next year. That's why I said it could go higher. Please understand the dynamics of this, okay? Now, the fourth point, like I said before, cost of construction is up 20% and going higher. So if nothing happens in the market, absolutely nothing happens in the market, and your cost of construction goes up, then your cost of apartment purchases is going to go up. It's very simple. The dynamics is very simple. If none of these other factors that I say, and number four happens, number four goes up even more. So we have been involved with developers. Every week we're involved with developers. We had a project in Mays Hill near Parramatta. Okay. And they said, okay, you can start selling this project 2 bedrooms for 560, 570, 580, Mays Hill. Then after we started selling, within a month, the developer came and stopped the sales. And what happened was they did not do their sums properly with the construction cost and did not realize how much the construction cost had gone up. So they repriced everything about 40,000 more. Okay. So next time we went back to market, it was 610, 620, 625 for the same properties. So this is a developer recently went broke in Queensland. You saw that, or everybody saw that, right? They went broke. It's a very big, not developer, a builder went broke. The reason why that builder went broke, massive builder actually, is because they quote the developers a price. And if that price, and the price is fixed, but their cost actually went up so much, they could not, when they went back to the developer and said, listen, it's going to be 15, 20% higher. Can we redo our contracts? And none of the developers supported them and the builder went broke. So this is very, very important factor. Number 5, and we'll talk more about number 5 in a minute, rentals are heading up and up. And we now have a chronic shortage of properties. I don't know if any of you are renting or looking for a rental property at the moment. If you're looking for a house at the moment, it is impossible to rent a house. For every house that goes up in any part of Sydney, there are 30 applicants within a couple of days. So people are asking, going around the corner to the agent and saying, I'll give you $50 more, I'll give you $100 more, I'll prepay my rent for 6 months. There is a chronic shortage coming up. I have been saying this for a while, and I'll show you in a minute. There's a FOMO effect. Those people sitting on the sidelines, waiting for prices to come down, waiting for something to happen, could not afford a house now because they've been sitting for 12 months, not buying anything. They have a fear of missing out. They can't afford a house. What are they going to do? They're going to buy apartments. Are we getting those type of inquiries? Absolutely. We have been talking to some of these people, telling them last year, beginning of last year, buy this house and land package. They did not listen to us. Now they're saying, we should have listened to you. Those that bought saying, thank God we listened to you. Okay. We've seen people's prices go up 60 to 65%. So those that are missed out and can't afford a house and land package now are coming and saying, I'm going to buy an apartment. You tell me what you want to buy and I'm going to buy. And we've had those type of clients coming to us over the last 3 months. Consumer confidence and business confidence is high. And then this last point is also always very important. Like it's the same as when you work for a company. If the company's got a strong balance sheet and they've got money, you want to work for that company. Okay. They can give you higher salaries and you can grow your career. The same thing applies when you've got a strong government, strong balance sheet who can fund their own projects, billions of dollars of projects. We have more projects in New South Wales, infrastructure project, including the airport and everything else. We have more infrastructure projects in New South Wales than the rest of Australia added together. Okay. I did not make that point before. That's another good point. We need to, so that's why our unemployment is 3.7 and that's why it's heading to 3.5 and lower. This will continue for the next 5 to 10 years. If you can't find a job in New South Wales at the moment or in Sydney at the moment, it's not, don't blame the job market. You're being too choosy. Okay. So this is not, it's never been so good. So these 8 factors is why I am saying, hand on my heart, this is a perfect storm, the perfect time to go and buy an off-the-plan apartment. Okay, this is why. So first and foremost, I talked about the huge gap that between house prices and unit prices. Second thing is This gap is going to start to close now. It's starting to close already. House prices not going to go up much. Apartment prices are going to go up more for all these reasons here. Okay. Higher rental returns is a big factor. Supply and demand and higher rental returns, those three things alone will move the needle big time. So what I'm saying to you today is, you go buy an apartment, pay a 10% deposit. The apartment may not finish until end of next year or maybe into 2024. You only pay 10%, but when the prices go up by 20%, you gain on the full amount. Example, buy an apartment for, let's say, $600,000. You pay only 60,000 now. Don't have to pay any more money. 60,000 is leveraging 600,000 because the 20% up goes on 600,000. 6 2s are 12. By the time you settle your apartment, if it's gone up $120,000, then you have made 120,000 by putting out 60,000. You all understand that, right? Simple maths. This is what I call price arbitrage. This type of phenomenon does not happen all the time. It is once in 50 years, you might see this type of phenomenon where you can take advantage of it. Okay, so that is my biggest advice to you today. Media is now coming out and talking about the big gap between house and unit prices. Okay, capital Sydney's gap was the nation's widest, with houses 523,000 more expensive than apartments. This is going to happen. You can write it down now. This is going to happen. Other media, you can quickly read all of that. Other media is now coming on since late last year. They've been coming on. So when you look at the right here, this is the property clock for apartments. This is my property clock for apartments. We're at the start of the recovery. This is rising market, approaching peak of market late next year. Okay, late next year. So the biggest percentage growth will be between now and end of next year. You got significant demand. You've got falling supply. You've got chronic rental shortage. It brings me to the next slide. This is an old slide. I intentionally have put this old slide here because I have been using this since August last year. In August last year, so our Sydney's rental vacancy peaked at 4%. It was down to 2.6% in August last year. Since August last year, every property seminar, webinar I have been doing, I've been telling people that by June this year, we will be at 1%. By late this year, we will be below 1%. Below 1% is chronic shortage in rentals. Rentals are gonna go through the roof. It's gonna, at least I would say 20% up, okay? Rent you're gonna pay. If you're paying 500 now, add 20% to it. People say to me, you're selling an investment property and you're telling me I'm paying 550,000, I'm going to get 450 rent. That's not a massive return. And I tell them, don't look at today's rent. You've got to look at the rent at the end of next year. That's going to go through the roof. Okay. So Sydney vacancy rates, you know, this is going back. So 1.9%, but this is the real numbers. Okay. This is the numbers at March 22. So like my graph said, and like I predicted, we were at 2.9 in March 21. We are now at 1.4 vacancy in Sydney across all property types, across our whole city. Nationally, we were 2. Nationally now we are at 1%. This is chronic shortage. That's why the media is talking about this every single day. I've been talking about it for the last 9 months. It's now happening, okay? Brisbane is really bad, really bad. Perth is really bad. I had an investor call from Perth and asking my advice, and they cannot find a rental property. I own a rental property in Perth. The rental was increased by 10% 3 months ago, and I did not put it on I kept on a periodic basis. Last week, I had another call from them and they said, you can raise it another 10%. I don't want to do that to my tenants, but this is a chronic shortage market. Look at Adelaide, look at Hobart. I mean, these numbers are chronic shortages. This is like almost saying there is no properties for rent. People are going to have to sleep on the streets, okay? This is a chronic problem, a major problem. In 3 months' time, this is going to get worse. In 6 months' time, it's going to be even worse because you cannot just go and get more properties. You cannot just find the supply. Okay, this is a big point. So this is the very simplest graph I'm going to put up today. I could put another 50 graphs, but I want to keep it simple. We're going to see strong economic growth. We're going to see we already seen strong jobs growth. As a result of these two things, wages growth will happen, okay, without a doubt. Population growth, I've talked about. Increased rental and buyer demand. All these factors here causes only one thing, increase in property values. It is not just about interest rates. Please do not read articles. Do not be swayed away from this negativity that is going to be there for a long time for the rest of this year, where people, oh, I don't know, but I thought that because of interest rates, somebody in the dark dungeon in the bank's economics area has done some modeling, and they reckon we're going to have so many mortgagee in possession sales, this is going to drive the property prices down. Absolutely not. I did say that when you're looking at properties, you don't just go and buy anything. You've got to understand what you're buying. Okay, location. Yes, very important. My number one. You've got to make sure these, I won't go through them. You make sure these things are happening. Okay, population growth, demographics, supply and demand. These things are very important. Anybody living in the northwest of Sydney, southwest of Sydney has seen all of this. More infrastructure, metros, all of those things are happening. Okay, there's more investment happening in the local area and job creation. So second most important thing is price. Do not ever, when you invest in property or buy a property, do not ever pay a premium. Please do not ever pay a premium. I have in my career seen a lot of people pay a premium and still haven't seen an increase in price. So what I'm trying to say is that, give you an example, in Wentworth Point, in Rhodes, in Meadowbank, you've seen millions of apartments. There's a lot of people who bought there 4 years ago, 5 years ago, off the plan. I talked to you about the Asian buyers, the Chinese buyers who just went and paid $900, $950 for a 2-bedroom apartment. When the time came and it was ready in 3 years' time, which was like 2 years ago, you found that the valuations did not stack up. Valuations were 100,000 less. And even today, they're waiting for the property prices to go up. That is not what we do, okay? We value pick a project. We have 25 projects in Sydney at the moment. We're only going to show you 2 projects tonight, and very quickly because of time, because I keep talking. But the reason why we show you those is because that is what we think is the biggest, best value, okay? Timing, I've already talked about. Picking the developer and builder is becoming more and more important, particularly in the apartment space, because you don't want to buy an apartment which becomes inhabitable, where you've got structural problems and so on. There's at least 5 or 6 now in Sydney which has got these type of problems. When we talk about infrastructure, we talk about hospitals, we talk about metro, we talk about business investment, as I said, we talk about new town centers that are coming up. Riverstone Town Centre is going to be as big as Rouse Hill Town Centre. Nobody's talking about it at the moment. But we talk to the councils and we talk to developers, so we know exactly what's coming in there. I'll let you very quickly read this, but our GDP in New South Wales, our economy is bigger than countries like Malaysia, Singapore, and so on. Our Northwest precinct, as I said, will become bigger than Canberra in 8 years. We've got Badgerys Creek Airport, Atropolis happening, more jobs being created in this Northwest area. This is an example of what is, location. Where do you buy? What do you look out for? What is going to become important in 2, 3, 5, 10 years? It compelled me to, what I've talked about today, compelled me to write an article in Indus Age, Australia's biggest Indian newspaper. And the message was very simple. The message is very, very simple. I talked about a project here, which we're going to showcase today. This project is the fastest selling project in the last 6 months in all of Sydney, and the good reasons for it, okay? I will stop there, and I'll get Krish to talk about our next 2 projects as quickly as he potentially can, and then we'll take some questions. Thanks, Krish.
Thanks for that, Sachin. Hey guys, it's Chris here from the Nivas sales team. Thank you all for attending tonight's session. Now, first and foremost, I wanted to just say from the outset, we've got access to 60 plus projects across Sydney, Brisbane, and Melbourne, right? These two projects we're talking about today have been value picked, hand picked by Sachin. He's done all the research in terms of pricing, developer, basically ticked all the boxes that any very astute buyer would be looking for before looking into an investment or a first home like this. So without further ado, Evoke Blacktown. Now, this particular project, it's located about 5 minutes walk to West Point Shopping Centre. It's about 5 minutes walk to the train station as well. The developer, as you can see here, a Jasara Construction. Now, Jasara have been around for about 25 years. They've done 40 plus projects in the past. They've built for the New South Wales government for certain projects. And look, the quality is truly second to none. Here are just a few of the projects I've done in the past. So the Wave on Princess Highway, which is a landmark sort of apartment block there in the southwest. You've got Villa Del Mar, which is another big project in Rouse Hill, which some of you may have heard of as well. And a couple of other smaller, more boutique projects as well, just to showcase what they've done. So they've got the experience, and amazing quality as well. So Evoke, guys, as you can see on the map there in front of you, basically you've got stage 1, which we've highlighted there. Stage 2 is actually directly across the road, which has just commenced construction, which I'll get into it in a little bit more detail shortly. But as you can see, guys, it's a 5-minute walk to West Point, 5-minute walk to the train station. It's only a 3-4 minute drive to the hospital, Blacktown Hospital. The new Australian Catholic University is there as well, which again is about a 10-minute walk. So you're walking distance to everything, which is a big plus. Now, if we just move across to the next one. Okay. So as I mentioned before, Blacktown is turning into a little bit of, it's turning into a hub essentially. So there's a lot of money being spent in terms of infrastructure, road upgrades, that sort of thing. What isn't happening too much at the moment is there aren't too many sort of brand new apartments coming up. So DAs have been kept on the low. So that's causing quite a few supply issues there. I've been told that renting out a 2-bedroom apartment is taking about 2 or 3 days now to rent out. So that's how high the demand is at the moment. So so the next slide will take you into a little bit more information about, gives you a showcase of what the finishes are like. So you've got 20 mil Caesarstone bench tops, 2.7 meter ceilings. You've got engineered floors. You've got ducted air conditioning throughout, Fisher and Paykel appliances. You've got plush bulk carpets in the bedroom. So this isn't one of those projects where you walk in, you think, oh no, it's, it doesn't feel like it's good quality or it's cheap or nasty. Very good quality. The bathrooms, in fact, you've got to see it to believe it. Their bathrooms, like this doesn't do any justice as to how amazingly they're finished. It's like you're walking into a 6-star hotel. They're really, really nicely done actually. So you've got a rooftop terrace as well in both stage 1 and stage 2. There's no pools, there's no gyms, there's no saunas, there's none of that. So that keeps your strata costs relatively in check as well, which is good. But again, plenty of room to break out if you wanted to get out there and hang out in the common areas. So, okay, stage 1, guys, we've got, so there's 100 apartments. It's finishing off in the next 8 weeks. We've got 6 1-bedroom apartments in there left. And we've just got 1 2-story, 2-bedroom apartment as well in stage 1. So if you're looking for something finishing quicker, that's sort of where we are with stage 1. Now, stage 2, we're taking expressions of interest at the moment. Now, stage 2, we're in the pre-sales phase for this particular project. So what pre-sales means is developers, needs to get X amount of sales and commence construction and whatnot. We have hit that point now where the developer has reached the right amount of sales to kick construction off. Construction has started. With that said, pricing for stage 2 is extremely aggressive at the moment. 58 square meter 1-bedroom apartments are starting from 413,000, right? You look anywhere online for a brand new 1-bedroom in Blacktown at that size, you're not going to find it. 2 bedrooms, average internal size of 83 square meters internal, are starting from 540. Now that, again, if you compare it to any other one, I believe the nearest starting price is about 570 for a 76, 77 internal from one of our competitors. So again, exceptionally well priced. 3 bedrooms, guys. In our first release, we've sold out of all of our 3 bedrooms. As per most developments, there aren't a huge amount of 3 bedrooms, and demand for 3s and 2s, and of course 1s to a lesser extent are quite high. But we will be getting a release of a couple more within the next week. Maybe looking at a ballpark price of around 680 for a 3 bedroom, just to show you. So if we, and of course there are other incentives which are available for Nivas buyers as well, which we can discuss in more detail. Yeah, so look, in a nutshell, guys, you've got stage 1 finishing very quickly if you want that. You've got stage 2, which is finishing, look, you'll be looking at completion about 20 to 22 months away. So you'd be looking at sort of the end of next year, beginning of 24 for completion there. And prices, the developer, the location, it's truly second to none. I mean, of course, we'd have to show you through everything to give you make an informed decision. But just even looking at this pricing, just go on real estate and compare. We are exceptionally well priced. So if we move on to the next slide. Okay, now the next project, guys, is Talawong Village. Now, Talawong Village is a project where pretty much most members of my family have bought one in here. It's a very exciting project. Just to put things in perspective for you as to what's going on. So you see that triangular building in the middle that you can see there? That building and the buildings on the right and the left of that are basically stage 1, right? Now, stage 1 is going to have a retail precinct underneath it. So you think of a sort of mini version of Rouse Hill Town Centre. So there's going to be 40 specialty shops, parklands, well spread out, not apartments all on top of each other, no high rises, so maximum 8 stories of apartments. And this stage 1 of Talawong Village, guys, has sold out in about 9.5 weeks. So that's about 335 odd apartments sold in 9.5 weeks. And that was during sort of the lockdown last year towards the beginning of this year. So, you know, the fastest selling project in Sydney, bar none. The biggest key point for this project is directly across the road, you have the metro. All right. So the metro, obviously at the moment, it can take you out to Epping and those sort of places now, but in the next 2 years, the plan is for this metro to connect you to Barangaroo, or to connect you to the city, basically, right? Now, once that occurs, it's going to do huge things for Talawong, right? Obviously, right now, the metro will still take you there, but it's going to obviously create more connectivity. You're going to have your shops right underneath there as well. So transport sorted, all of your convenience of the shops are sorted as well. You've got good schools within the catchment as well, which is another good thing. So hence the reason why it sold so quickly. Now, across the road in the back there, you'll see some buildings. That's stage 2, which is what we've launched right now, which I'll get into in a bit more detail.
Can I just add one thing, Krish? So
yeah.
This is Talawong Road on this right side here. There are houses you see in the back is ponds.
Yeah.
So the house and land around here has gone exponentially up in the last 18 months. Talawong Road, we were selling 300 square meter blocks for 550 about 18 months ago. And those same blocks are now 920, okay? 550 to 920, do your sums. It's not 30%, 40%, 50%, you're talking more like 80%. So that's the type of growth that the land value has had there. And that same time, the apartment values here really only has gone up about 10%. So when you're talking about gap, the same with ponds. I mean, anybody who owns a house in ponds will tell you how much the prices have actually gone up in the last 18 months. It's gone through the roof. So this will catch up. And that's why people are seeing the convenience and the lifestyle that this type of project actually brings on the table. You're right next to a metro. This metro is going to go for 5 stops to the new airport, 15, 20 minutes to the new airport. The values will only go up, only one way. Okay. So
thanks, Sachin. So this is just a bit of a snapshot as to the retail precinct that's going to be underneath. So you can have shops, restaurants, cafes, supermarket, you know, a butcher, all that sort of stuff will be there. So it's going to look really nice. Again, as I mentioned, well spread out, good privacy, and look, a build quality which is second to none, which I will get into again in a moment. So if you look inside here, you've got 40 millimeter Caesar stone bench tops, 2.7 meter ceiling, engineered timber floors. So these are proper timber floors. You've got really nice layouts, good bathrooms. Now, these bathrooms, they're called a pod system bathroom, which I will get into in more detail once we, if we do meet for a one-on-one. But these bathrooms cost about 30% more than a regular bathroom. They're prefabricated in Melbourne, brought to Sydney, slotted in, pressure tested, waterproofing tested, everything tested to make sure there's no leaks, no issues. Again, just a testament to this developer, Daycorp, who go above and beyond. Now, if we move to the next slide, location, as Sachin mentioned, you're across the road from the ponds, you're one stop away from Rouse Hill Town Centre, you're a stone's throw away from Norwest, which is obviously an employment hub in itself now. You're not too far away from Parramatta. Rouse Hill Hospital is around the corner as well, so that's not too far away. It's literally probably a 2-3 minute drive, if that. Then you're obviously beneficiary of Tullawong Station. If you want to go to an actual train station, Schofield Station is only a 5-minute drive away as well. So in terms of convenience, it's, as Sachin was mentioning before, there's going to be a lot of, or there is a lot of migration happening from overseas and also interstate. And a lot of people who are moving here, they don't have a car that when they first come here, right? So convenience is the thing they're going to look for. Demographic is another thing they're going to look for. And, you know, Rouse Hill ticks that box. White collar, good demographic as well. And
a couple more points, Chris. So in this project, it's worth mentioning that the so ground floor is all shops in this first stage. You've got your gyms and all that kind of stuff. But level 1 in all these 5 buildings, level 1 is going to be your medical centers, doctors' offices, imaging centers. And the reason why they have done that is because it is 3 minutes in the metro to the new hospital that is going to come out, Rogers Hospital. Okay, that is a very important factor to note. And all those rentals are going to be, all those leases are going to be controlled by Daycorp, the builder. So that is absolutely key as well in terms of this development. It's future growth.
Correct, 100%. Yeah. So yeah, guys, look, very good location. As you can see, you don't need a car. You can just basically live there, and everything's walking distance away. Then look, stage 2. So stage 1 is sold out. Stage 2, as I mentioned, which is going to be behind that, completion is going to be around Q3 2024. So you've still got a bit of time for that one. 1 bedrooms are starting from 540. 2 bedrooms from 675, 3 bedroom from 940. Now these are very well priced compared to sort of any other projects in the surrounding suburbs. The quality is second to none. The developer Daycorp, who are the guys who are building it, Daycorp are the 3rd largest builder developer in Australia at the moment. They've recently won the tender to build this, Castle Hill, and also Rouse Hill as well from Landcom, the New South Wales government. So the government has entrusted them to do this build, part of the New South Wales Growth Priority Precinct. So guys, you got, again, good location, exceptional pricing, good developer. And stage 2, we have quite a few good options. We have pretty much sold out of the first building in stage 2 now, but we will be launching the next building shortly. And yeah, in a nutshell, there are a couple of...
one other thing, sorry to interrupt, Chris, is that 70% of the buyers that are buying in this complex are owner-occupiers.
Right.
So only 30% will be out for rental. Whenever you're buying for investment, you always look for the lower percentage being rental properties and more owner-occupied. That keeps your value up and the demand up. But the testimony really is that, you know, like Christian said, you have got the highest selling probably in all of Sydney. In 9 weeks, literally you've sold out about 333 apartments. That is unheard of when half of the 9 weeks was during lockdown. Okay, so in terms of concluding, I conclude always in the same fashion with this slide. And what I'm going to say to all of you is, to become wealthy, the simplest way to become wealthy is to actually invest in property. And it is not by chance that Australians have become per capita the wealthiest people in the world. It is because they actually invested in property. The house values and the investment values all went up significantly. almost 3 years now that we have gone past Switzerland as the richest per capita country in the world. Now, if you have money lying around, for example, when I say that, it may not be in the bank. It may be equity that you have built up in your house or an investment property. And that equity is not working for you if you are not actually using that equity to make more money. So for example, if somebody listening to me tonight has got a house and the house has got 150,000 equity in it, or 200 or 300 or 500, could be anything. You may not know that you can actually be buying 1, 2, or 3 of these apartments, okay, and make that equity actually work and generate that wealth. I bought here with my eyes closed because I know it is going to go up. It is right next to our metro. When I first saw Macquarie near the university and near the metro, property prices, 1-bedroom apartment there, you cannot buy for less than 750, and a 750,000, and there are 51 square meters, a 750,000 1-bedroom apartment there is not going to have a parking space either. Okay, when you look at Castle Hill, you look at Norwest, you look at Bella Vista, you know that you cannot buy a 2-bedroom apartment there less than 850, maybe even some of them are 900, and they are smaller in size than some of the apartments we're talking about here. It is only a matter of time. When infrastructure comes in here, by the time your apartment is completed, you will be sitting on a profit. I am very, very confident. So I bought one, and we got one of our daughters to buy a 1-bedroom as well, because I can see that the value is absolutely going to go only one way here. You're going to be 4 or 5 stops to the new airport. Okay, so it is convenience, it is lifestyle, and that is what actually gets you a growth in your property prices. Now, I'm happy to offer any of you listening today to call me to discuss your needs. I'm happy to sit down with you. I don't charge for it. You don't have to buy anything from me, but I have a passion to help people actually accumulate wealth through property. And I would urge you all to look at both these 2 projects, because both these 2 projects provides good value. You will not be able to buy a 2-bedroom apartment in Sydney in 2030 for under $1 million. You did not hear me wrong. In 2030, you're not going to be able to buy a 2-bedroom apartment for under $1 million. Impossible. 7 years ago, you could not buy an apartment in Blacktown 7 years ago, only cost $280,000. So it's doubled in 7 years. Okay. In the next 8 years, it's going to double again. I can tell you it's going to double again. That is the trajectory our population is going. That is the trajectory everything else is going. So if you're not going to invest in property now, the only thing you're going to say, if you don't buy an apartment in the right place right now, you don't have to buy from us. You can go look for other properties as well. But my advice to all of you is the same that I said to people 18 months ago who were looking at house and land. I said to them, close your eyes and buy it. Those that didn't are regretting it. If you're going to sit around and wait for corrections in prices, it ain't going to happen. So the Blacktown one, for example, you can still buy a 2-bedroom apartment for $545. You cannot buy that anywhere else in Sydney. Even in Mount Druitt, you cannot buy for that much. In Penrith, you cannot buy that for that much. Okay. This is a place which is growing. It's got transport. It's got hospital. It ticks all the boxes. All the boxes. You can catch the M7. You can catch all the freeways and go any direction from there. So what I'm saying to you is this opportunity is not going to present itself maybe in 3 months' time even. You don't have to even wait for end of next year to say, well, that guy I should listen to that guy because I would have been sitting on at least 100,000 profit now. So this is an opportunity not to let pass. And I will, with that, stop and take some questions.